Let's stretch our brains a little and see if we can't make sense of what's happened over the past 5 years and what we're likely to see over the next 5. If you want to understand price movements in gold and silver, you have to understand currencies, especially the dollar. Everyone knows that the US currency used to consist of gold and silver certificates. These certificates were essentially warehouse receipts that could be redeemed for actual metal. The redeemability for US citizens was terminated in 1933, but the rest of the world still enjoyed the privilege of using the US currency as a claim on real gold in the Treasury. In 1971, Nixon closed the gold window, ending the era of convertibility of US currency for real metal. Many people claim that this change made the US dollar backed by nothing. This is not really true. Let's discuss why. All of the world's fiat currencies, including the US dollar, are backed by the productive efforts of the citizens. When you do productive work, the government has the right to tax away a portion of the work to pay for not only government expenses, but also government debt. In addition, municipalities will tax real property to pay for expenses. This creates a real demand for dollars, which is what gives the dollars their value. If you don't believe me, try paying your taxes in something other than dollars, or not paying your taxes at all, and see what happens. The dollar is therefore no longer a claim upon gold or silver, but a claim upon your future effort. Thus, for any fiat currency, it is the taxing authority of the government that gives the currency its value. Now the dollar has something else that adds to its value, which is the fact that OPEC prices their oil in dollars. This has enabled the dollar to act as the world's reserve currency, though that role is in transition and will change at some point soon. The petrodollar status is a fairly complex subject that I won't cover here. If you want to learn more, please watch my video titled Gold and the Petrodollar. Okay, so we've established why there is a demand for dollars despite the lack of gold or silver backing, but have not yet discussed quantitative measures that can help us understand changes in the value of the dollar. Stick with me for a few seconds. This slide is going to be very dry, but it will be important for the remaining discussion. Ben Graham, the father of value investing, once said that the value of any enterprise is the amount of new money that can be safely borrowed against it. Jim Sinclair, otherwise known as Mr. Gold, once said that the dollar is the common stock of the USA. Both of these statements make complete sense, and so it is natural to consider that the dollar, which is the common stock of the US, can be valued by considering the productive real output of the US going forward, the amount of debt that has already been extended, and the number of dollars that exist. So quite simply, the productive effort of the citizens that does not already have claims made upon it is basically future economic output less the debt that already exists. If we want to put a specific value on each dollar, it will be that difference divided by the number of dollars. If we want to place a value on the total money supply, we simply need to consider the difference. The number of shares outstanding is immaterial. This is very similar to how a company would be valued. The total value of the company is future revenues less expenses less the current debt outstanding. The number of shares outstanding does not need to be known to calculate the total value of the enterprise as a going concern. The same is true for a country. Okay, now that we have this concept down, we're prepared to move forward. Many people get upset because the US debt is very close to our gross domestic product, but we've been here before. Here I show the US debt in blue and our GDP in red from 1945 onward. Right after World War II, our debt was higher than our GDP, yet we managed to grow very strongly after World War II. So in other words, we've been here before and we got through it. Back then, the debt was 1 year worth of production. Now the debt is, again, 1 year worth of production. So what's the problem? Well, the problem is that the GDP is a false measure of real economic activity. The GDP is simply the sum of all dollar transactions taken over the course of a year. Suppose somebody pays me $1,000 to go to a field and dig a hole. That has just increased the GDP by $1,000. Suppose someone pays me $1,000 to go back into the field and fill that hole back in. That transaction increased GDP by another $1,000. No useful economic work has been done, but GDP has risen by $2,000. So GDP is really only a measure of money velocity, not actual real economic activity. GDP has no bearing on the quality of the economic activity of a nation. Let's look for a better measure. Let's consider total energy consumption in the US. Here, I'm showing total energy consumption as a blue line against the total debt shown in red. The total energy consumption has been provided by the Energy Information Administration, or EIA. It covers the consumption of oil, coal, hydro, nuclear, wood, etc. I think this is a better measure of real economic activity because all economic activity involves the consumption of energy, whether it is the production of a real good or the transportation of a real good. It is also a very difficult number to massage by government statisticians in order to make it look better. So let's use this and let's see where it takes us. Before Nixon closed the gold window, the US debt grew more slowly than our real economic activity. This meant that someone could take their dollars, invest in US debt, and upon maturity would be able to purchase more real value than if they had just spent their dollars instead of investing them in the first place. By buying US debt, the person or country would be better off. After the gold window was closed in 1971, the debt grew much faster than real economic output. This meant that someone who bought US debt was guaranteed to lose purchasing power unless the interest rate was significantly greater than the difference in the growth rate of the claims on future output and the growth rate of the output itself. In other words, the interest rate on the debt had to be higher than about 8% in the 70s and 80s. Well, guess what? Investors started to abandon the dollar until Volcker came in and jacked up interest rates to substantially higher than 10%. Once he did that, there was a real economic incentive to holding US debt. There were also some deals struck between the US and Saudi Arabia, which involved gold, that helped keep people interested in the dollar. Again, if you'd like to know more, please watch my video, Gold and the Petrodollar. Notice that the rate of increase in energy consumption from 1945 to 1970 was considerably higher than it was from 1970 to 2000. Part of this was due to the peaking of oil production in the US in the early 70s. Much of it, though, was due to the fact that energy was becoming more and more expensive to extract and transport. After all, it takes much more energy to extract oil from offshore platforms than it does to extract it from inland, and so the energy return on energy invested, or EROEI, has been gradually declining. The period from 2000 to 2013 is very interesting because for over a decade, our total energy consumption, which is a good indicator of total real economic activity, actually went into a long-term decline. Yet, our growth in national debt continued at about 9% per year. If international investors were nervous in the late 70s and early 80s that their debt investments would pay off, they surely are doubly concerned about it now. So let's change the scaling a little bit and overlay the two graphs. Remember, the real value of the total money stock of a country is equal to the remaining value that will be generated by a country in the future, less the claims that have already been made on that output. So if real economic activity is increasing at a slower pace than the debt, then just like for a corporation or even a private family, we'd expect that at some point there will be no real economic value left to extract. I took my best guess at how to scale the two graphs, and this is what I came up with. Notice that the two cross over in 2008. Does that year remind you of anything? Well, it's the year when we started our long financial crisis. Our leaders tell us that we're recovering, but total energy consumption tells us a different story. It's a situation that's getting worse, not better. Over the past 5 years, foreign entities, particularly China, have scaled back their purchases of US Treasuries. They've realized that with the US in decline, the purchase of US debt is a guaranteed loser in real terms. At this point, even if the debt doesn't grow a single penny, it will be impossible to pay back the existing debt with real value that exceeds the original principal. Yet, still, the US is borrowing money. With foreigners no longer buying the debt, it forces the US government to get their cash flow from somewhere else. And that cash flow is coming from the Federal Reserve. Yes, The Fed says that they're monetizing the debt to foster economic growth, but the real reason is that the U.S. needs to continue borrowing, and there is no one else left to lend them the money. We can see the effects here. Ever since foreigners stopped buying our treasury, our money supply has increased dramatically. But as I've said before, the number of currency units does not change the value of the total money stock. It only changes who has a claim on the future productive output of the U.S. And yes, this is a fact that has not been lost on our former benefactors. So let's take some guesses as to what's going on now behind closed doors and what's likely to happen in the future. First, the U.S. is in real economic decline. It's not the debt that's suppressing economic output, because we've had these levels of debt before relative to GDP, just before an era of significant increases in economic output, as a matter of fact. No, it's mainly due to the fact that energy, while still plentiful, is coming at a greater and greater cost. This makes our debt a losing proposition long term. Each year that goes by, where energy consumption does not keep pace with debt production, means that it's less likely that the holder of U.S. debt will receive more value than they gave up. Once real economic activity goes negative, it will be impossible for any interest rate to compensate the person who gives up current purchasing power. Think about that for a minute. It's unlikely that we will default because we can just print, but foreign holders of U.S. debt are guaranteed losers. They know this, and they want out. Not buying any more debt was a no-brainer. But what do they do with their existing debt? They've sacrificed significant amounts of purchasing power in the past. They'd like their existing debt to be converted into real goods and services, preferably getting as much value for it as possible. But if they sell the debt on the public market, they're likely to crash the bond market. This isn't what they want. If they sell a little at a time, though, and have the Federal Reserve buy bonds to keep the bond market propped up, well, that will give them the cash that they're looking for. However, without additional action, the value of that cash that they held themselves would decline due to dilution. But if the government were to orchestrate a suppression in the price of the assets China wants to acquire, while this process goes on, then China will be happy. They will be able to get real value in exchange for their debt. I think it's very likely that some backdoor deals have been made. But when does this end? Well, it will end when all of the elite in all of the countries have their positions established so that they can get through this reset without being harmed. Based upon my analysis, I think it's very possible that gold and silver have no real price now. Only the price that's been set by derivative contracts. It's not obvious, but neither is it meant to be. If it was obvious to everyone, then the whole unwinding operation would collapse immediately instead of slowly as it is doing now. We are likely to learn what the true value of gold and silver are, but not until after all of the pieces are positioned the way that the elite want them to be.